Okay, in this video we're going to continue our discussion about forecasting and forecasting financial statements through what's referred to as pro forma analysis. So let's now ask questions about how well we're doing. How efficient is our model? So we have something referred to as the mean absolute deviation. So you look at the deviation. What's the difference between what happened and what we forecasted to happen? That's the error that we're talking about. But you use it in what's referred to as its absolute term. So you're going to use the absolute value of that deviation, and then you sum that deviation. And of course, we'll probably be doing some averaging, right? So MAD is just simple. It allows us with the method to determine maybe we need to adjust our model. Maybe we'll add some weights to the model so that the most recent years are more valuable than maybe 3-4 years back. So this absolute deviation again is just the actual number minus the forecast. This is the error that we made in our forecast. So we want to analyze the importance of this error. So we could use just the average, right? What is the actual average? In this case, you can see that the average deviation is 0.17. But the average absolute deviation is 13.5. That number is going to give us a number that's much closer to the values above here, right? So by definition, if you are averaging many numbers, some of which are negative, some of which are positive, if you're averaging, you should get something over time very close to zero. We want to take the absolute value, so we get a number that gives us a better reflection, if you will, of how close we are to making these changes. So the mean absolute deviation, again, is just the sum of those deviations, right? The means of those deviations, and it then divides it by n. So what does this look like in a spreadsheet? So we're going to take some time looking at this spreadsheet. We have monthly data here. If you look how many time periods we have, there are 24 time periods. Here's the sales figures for this monthly basis. And then we're going to use what's referred to as a 3-month moving average. Take these three numbers, average them, gives us the forecast. So our forecast, as we mentioned earlier, is 246.33 in April. But April actually produced 260 units. So the deviation is 13.07. The absolute then is 13.07. So now we want to find the sum of those. So the sum of those deviations is 255. There's 21 observations total here, which means that the average deviation here is 12.16. Of course, we would like this to be closer to zero, so maybe we need to figure out a better way to do this. What if we did 4 months? Will 4 months give us better predictive ability? Well, we now have to then look at what is the actual sum. So in this case, we end up with a number. The mean absolute deviation is 11.6, which means our predictive ability is now better. An alternative thing that we might do is we may find ways to put a weighting system in here. Is there a weight that we can attribute to this? So maybe we put a 3 as the weight for the most recent month, 2, and then 1 for 3 months. So we give it some type of weight so that the more recent numbers provide more information or provide more impact, if you will, on the prediction than previous numbers. So again, graphically, what this looks like is here's the actual numbers, and what you see is the forecast. It gives us a little bit of a smoothing pattern. Now, when you watched one of our videos previously, it talks about what happens when the actual numbers cross the prediction numbers. Or if you have a short-term and a long-term prediction model, what happens when they cross each other. So it gives us some indication about whether numbers are actually increasing or whether numbers are decreasing, dependent on how these moving averages relate to each other, right? Or how they move with each other. Here's some stock prices. I used a 3-day average, a 4-day average, and then I did a 3-day weighted average and a 4-day weighted average. And again, what it creates for us ultimately is this graph of how things seem to work. And again, you can see that the actual number is the blue, and the other numbers, they do seem to follow it, certainly very closely. But we'll see that in the end, you may have some prediction, need to understand whether or not this predictive model is a good model or not a good model. One of the places where this is used is in Yahoo Finance. You can use this. There are lots of pricing models for companies. So this is Coors, and it shows the shaded area here. That line represents the actual prices. And then we have two kinds of moving averages. We have a 20-day moving average and a 20-day exponential moving average. And as you can see, they follow each other. They're not exactly on top of each other, but they follow each other fairly closely. Again, one of the things we might want to do is look at an actual company and see if we can get any information that from these types of moving average models. The last kind of model we can have is something called a causal model. And this data comes from the economy. It comes from outside the company, if you will. So what things outside of our company have an impact on the revenue of the company? These can be kind of simple. They can be complex. We usually have to use some higher levels of statistics in order to determine the predictive ability of some of these models. And certainly for this class and for most small business managers, that higher level of statistics might be something a little bit beyond our capabilities. The last thing to kind of talk about is how we can utilize this forecasting. Right? One of the things we may need to do is develop a business plan. A business plan is going to have predicted financial statements in it. So we need to have ways of predicting sales forecasts, right? We need to maybe look outside the company, get some advice from other people. We need to look at competitors, look at the industry kinds of numbers. But we want to think about some basic types of expenses: startup expenses, fixed expenses, and variable expenses. And one of the things we want to do is develop a revenue forecast. Now, when you're starting a business, this is extremely difficult, right? We need to have data to make prediction. So without a history, getting this started creates a lot of uncertainty in our predictive models. But nonetheless, again, if we predict, maybe even do like best and worst cases, finding out some averages, calculating gross profit for a company based on the information that we input. Again, we can have some type of range, if you will, between the best case and the worst case as far as weekly numbers, and then convert that obviously to annual numbers. So again, this forecast of revenue is very difficult with a startup, but we do know some numbers, right? We actually know what the hourly wage is going to be. We know what overtime wages are. We know how many workers we'll have, how much time they're going to work, right? So we have some ways. Some of this information we'll know, and some of it is not quite as well known. The ultimate goal of forecasting for many businesses is to try to get a picture of where the company is going to be in the future. And the simple process, and let me take that back. It's not really all that simple, but the process is rather straightforward. Take information that you know about today, predict some changes in the future, such as what if sales increase by 10%? How will that affect the financial statements of the company? And what we end up with is a sales number. This is the actual numbers for 2007. And then we're going to use that information. In this case, it looks like about a 25% increase in sales. How does that affect the income statement? So you see we went from net profit of negative $3,900. Next year we should see profit of about $9,800. What's going to happen to cost of goods sold? It increases. What happens to rent? That stayed the same. Utilities will go up a little bit. Salaries will go up a little. So all of these line items are all related to sales. We found these numbers. You can find these numbers by doing a common size statement analysis for income. An income statement common size analysis. It can help us with some of these individual numbers so that we can predict what's going to happen in the future. We can do this much more looking at cash, right? Here's our monthly cash balances. Here's the cash payments. Here's our monthly cash budget, what we expect as far as cash flows. You can see here that in March, we expect a large cash outflow, $2,337. We better plan for that, right? So in the end, we have a cash balance that we know will actually cover that. We know that the cumulative or the ending cash balance in March, even though we have a big outflow, we still have $4,000 in ending cash balance every month. So we're planning on our need for cash on a monthly basis. We can expand this view to looking at balance sheets, right? Here's the current assets and the liabilities and the owner equity for this year. And here's what we predict for the next year. Now, how do we actually get these numbers to work? It is a little bit of a more complicated process than what is outlined in this text. So I'll leave that for a later course or a later video for you to truly understand the complexities of how this works. But essentially, the way pro forma statements are created is through something called a percentage of sales method. We're going to assume that the changes in the balance sheet and the financial statements, income statement, are all related to the change in sales. So we ultimately then can say, well, wait a minute. What is the change in sales? We expect sales to go up, the percentage for sales, balance sheet entry divided by actual net sales. So 4,000 divided by 2,000 means there's a 2% change in sales. How does that affect the financial statements? Well, again, cash is related to sales. $4,000, rate that to the change in sales, it's 2%. So 2% of 4,000 added up ultimately gives us a pro forma prediction of $5,000 in the next year, and vice versa. So you can see all of these percentages relate to changes in the previous number. But these numbers come from common size analysis and relationships of the balance sheet to sales. Now, it's not really as simple as that. But in the end, what we're really looking for is we're trying to find out how much cash we need for the company. So if you look at this formula, the required financing is the percentage of sales that we need multiplied by assets divided by sales. That's 1 minus the total asset turnover ratio, minus the change in sales divided by liabilities divided by sales, minus, again, this S2 here, that's the ending sales number, times P, right, times price, minus 1 minus the payout ratio for the company. So again, we can find out for this company when you plug the numbers in the end, this company is going to need $6,072 to finance next year's operations. So really, that's what pro forma analysis is all about. It's predicting the future to understand where we think the balance sheet and the income statement will go. But the most important piece of information we get is, how do we need to finance what we think is going to happen in the future? You don't want to get to next year and find out you're $6,000 shy. You want to predict that ahead of time. So that's what this pro forma analysis ultimately does for us. We also can look at how the financial statements change over time by calculating ratios. So if you had a pro forma balance sheet and income statement for, say, the next 3 years, you could calculate the financial ratios for the next 3 years and see how you think the financial soundness of the company will maintain itself given your prediction of the future. In other words, do you think the company is going to get stronger or weaker? If you think it's going to get weaker, what changes can you make now to turn that around before that bad thing actually happens to us? So finally, we just need to monitor things, right? Every business process is a cycle. You analyze something, you make some changes, and you wait to see what happens, right? Once you measure what happens against what you thought was going to happen, we need to start the process all over again. We need to fine-tune the forecasting piece. We need to make changes in how we do business to improve our overall financial soundness. So there's lots of things to this forecasting process, if you will. Most of it, quite frankly, is beyond what we want in this particular small business context. But everybody needs to have a way of predicting the future. You need to have some thoughts about where you're going to go in the future. Small businesses will tend to use these simpler techniques. The more money a company has, the more resources are available for a company, the more data they can generate, the more experts in the field they can employ to help them with the forecasting. Things get bigger when business gets bigger. So hopefully that was at least an introductory insight into pro forma analysis and how forecasting fits into the game.